welcome to Lecture 11 in Applied Portfolio Management on the topic of funds management. So thus far today we've looked at the portfolio management process and particularly the asset allocation and security selection decisions from the perspective of directly investing on your own behalf or on behalf of a client. However, an investor also has the option of investing indirectly via a fund. There are a number of different types of managed investment vehicles that operate within Australia, and we're going to quickly provide a summary of those. So first of all, our insurance funds. Even though you might not think of an insurance office as a fund, it is, because what an insurance office will do is it will take the money from its customers in terms of premiums on insurance policies. It will invest that money in the intermediate period, and then it will make payouts when required based on pre-specified events actually occurring. And interestingly, the type of investment decisions made by insurance funds depends on their need for capital. So general insurance offices that have less predictable, more frequent need to make payouts, they tend to invest in short time horizon, high liquidity investments such as government bills, whereas life insurance policies, whereby the payouts on aggregate are more predictable and more long-term, they tend to invest in higher risk, long-term, less liquid assets, including equities or including longer-term investments. The second category is superannuation funds, and superannuation is particularly pertinent in Australia given the system of compulsory superannuation, whereby an employer is required to currently contribute 9.5% of an employee's wage to superannuation in order to create an enforced savings for their retirement, with the idea of taking the burden off the government to fund the pension liabilities. This level of superannuation guarantee payment is due to increase up to 12% by 2020. So given this large amount of money that's been placed within the superannuation system, there is a huge amount of money invested in superannuation funds within Australia, and this means that the funds management industry is significantly important within this particular country. The next type of investment vehicle are unit investment trusts. Unit investment trusts are pools of funds that are invested in a portfolio whereby the assets or the constituents of that portfolio are fixed for the life of the fund. So we don't have a fund manager buying or selling, it's just a trust that's created over some pool of assets. Often an example might be, for example, if you've got several siblings where their parents might bequest them certain assets and those assets are held on trust. That's actually an example of a unit investment trust, but it can also be a vehicle that is used in order to distribute other particular assets. So if you wanted to, for example, buy a property with a group of friends or family, you would likely structure that as a unit investment trust. Unit investment trust can also be created over a portfolio of shares, in which case the fund manager will just set up that portfolio but won't actively manage it. It'll just be a passive buy and hold type portfolio. And in this case, investors liquidate their investment by selling back to the trust. And you can sell back to the trust at the net asset value, which is calculated at the end of every day. The next type of investment vehicle is a managed investment company. Managed investment companies, or managed funds as they're also known. This is where you have a fund manager that is somewhat participating in the investment process. Hence they'll charge a fee of anywhere from 0.2 to 1.5% per annum, and they will basically manage a particular portfolio on behalf of the client. Two different types of managed investment companies are, first of all, index funds. In an index fund, the underlying portfolio is passive, and the role of the fund manager is just to rebalance the portfolio back to the market index where required. So, for example, the index you might be tracking might be the ASX 200 index, which is the 200 largest stocks in Australia. So every quarter when that index is reconstituted, the portfolio manager will just have to buy and sell such that their portfolio tracks that index as closely as possible, but they're not actively doing research, not actively buying and selling stocks based on fundamental analysis. Second type of managed investment company is an active fund, and this is where the fund manager is far more proactive. They are actively trading on behalf of their client and seeking to achieve alpha, seeking to outperform the market by doing so. Other forms of funds include real estate investment trusts, which is basically just an investment trust where the underlying asset is some sort of property or real estate. Exchange-traded funds that we'll look at in further detail in a moment, and hedge funds that we'll also elaborate on down the track. So next issue to examine in this lecture is the question of how a managed fund, which is also called a mutual fund in the context of the US, how it operates, and to analyse evidence on the relative performance of active and managed funds. So what a managed fund will do is that they will take the capital or take the money from their clients, and then they will go and invest that money on their behalf. Now, there's a couple of important points to note about managed funds. The first of those is that they can be either open-end funds or closed-end funds. A closed-end fund is where there's a fixed number of units that are created and no additional units will be created across time. Whereas an open-ended fund allows for the creation and redemption of units so that the number of units within that fund can actually vary across time. Now, within a managed fund, the net asset value will be calculated at the end of every day. The net asset value being basically just the market value of all the constituent assets within that fund. If you want to redeem your shares in a managed fund, what you actually have to do is sell those shares back to the fund manager, who will either go and sell them on to another investor or redeem them by selling part of the portfolio. What you have to do is you have to make your declaration that you seek to redeem your shares, but redemption only happens at the end of every day. It doesn't happen instantaneously, and it occurs at the net asset value as at the end of that day. So in fact, the redemption process is risky in that you're susceptible to any volatility that might occur between the point when you make your decision to redeem and the close of trade that particular day. And this is often a characteristic of managed funds that some investors don't like. Now, I mentioned earlier there are two types of managed funds, both active and passive. And the question is, well, which tend to perform better? Well, interestingly, the evidence shows us that while active funds do tend to generate a small positive alpha before transaction costs, they actually, on average, have a negative abnormal return after taking account of costs. That is, investing in active managed funds is actually wealth destroying. The reason for this is that markets are reasonably highly efficient, and as I mentioned earlier, active fund managers will charge a relatively large active fund management fee, maybe in the ballpark of about 1% of your assets under management. That means that in order for them to earn a positive abnormal return, they have to not only outperform the market, but they have to outperform by at least 1% every year to be continually outperforming. And that hurdle is quite a high hurdle, and on average it's too high a hurdle for the average active fund to actually overcome. The next type of investment vehicle are exchange-traded funds. So it's interesting to understand exchange-traded funds because they're a relatively new phenomenon when it comes to funds management, but they have grown significantly in popularity. The growth is highlighted by the fact that the single most traded security on the New York Stock Exchange is now the SPDR ETF, which is an exchange-traded fund that tracks the market index as a whole. So these are hugely economically important and important to investors, so it's important to understand what is an ETF. Well, an ETF is created and redeemed in a process that's almost exactly the opposite of a mutual fund. When you're investing in mutual funds, as we discussed earlier, investors send their capital to the fund company, and the fund manager then goes and uses that capital to purchase the securities or whatever asset it is that they're buying. When investors then wish to redeem their shares in a mutual fund, the cash is returned to the mutual fund, who goes and sells those shares basically on their behalf. However, when an ETF is created, it actually doesn't involve any cash at all. The process begins whereby you've got a prospective ETF manager, or as they're more commonly known, a sponsor, and they'll form some agreement with an authorised participant, which is generally some large institutional investor, who is able to either create or redeem ETF shares. So that authorised participant will borrow stock shares often from maybe a superannuation fund, and place those shares in a trust and use them to form what's called the ETF creation units. These creation units, they're bundles of stock that vary in size, but often are around 50,000 shares or so. And the trust provides shares of the ETF, which are legal claims over the shares that are held in the trust. So you've got the trust, and the exchange traded fund sits over the top of that trust. Shares in the ETF give you a legal claim to those underlying shares. And they give those shares back to the authorised participant. So it's just basically a swap. What they're doing is swapping the underlying assets for the shares in the ETF. So there's no cash actually changing hands in this particular case. And the ETF manager will then go and sell these units, these ETF shares, on the general market through an IPO, just like a company listing on the market. When an ETF trades then, the ETF shares trade just like a normal stock. So you buy and sell them on the market as you would a normal company. And this is the key benefit of exchange traded funds. Given they trade like a stock, they're highly liquid, they're able to be sold quite easily, and they track underlying indexes very closely. Now, because you don't have the intervention of a fund manager that actively needs to be trading, basically you've just got the manager who's involved in creating the portfolio initially, but no further costs, you've got no further overheads, so they're much cheaper in terms of ongoing management fees compared with a mutual fund. However, there are some negatives associated with exchange traded funds. Obviously, because they trade like a stock, you pay the same transaction fees that you do with a stock. So there's hidden fees, things like the bid-ask spread, for example, which doesn't tend to be a problem with highly liquid, really large exchange traded funds, but can be an issue if you're trading in a small exchange traded funds. Some other issues is that dividends in exchange traded funds are not actually automatically invested. However, in most mutual funds you do have an automatic reinvestment of dividends, so depending on your preferences with respect to how dividends are treated. And some people might argue that if behavioural forces do affect prices, if prices are not necessarily always a true reflection of fundamental value, then the price of the ETF might actually vary from the value of the underlying securities. So you might have some deviation between the price and the underlying securities, and potentially that's an added layer of risk for the investor. But by and large, this new innovation in financial markets is a low-cost way of investors achieving diversification, and it's been very popular, as you can see with the large volume of trading that I spoke about earlier. So the last type of fund to cover in this lecture is a hedge fund. Now, a hedge fund is not something that's able to be clearly defined. There's not some formal definition of what a hedge fund is. However, how we can define a hedge fund is by identifying what it's not. We can look at how a hedge fund differs from a traditional managed fund. So there's 5 key ways that hedge funds differ. The first of them is the legal structure. Traditional managed funds will generally be set up as a company. As a company requires a significant amount of disclosure, so too do managed funds. They have to disclose their holdings, for example, on a quarterly basis. In contrast, a hedge fund is generally set up as a limited liability partnership. So a limited liability partnership will actually create different legal requirements. They won't be required to disclose as much information. There is not as significant governance requirements placed upon them. But the big negative of this is that hedge funds actually aren't allowed to advertise because they're set up as a limited liability partnership and not a company. So related to that first difference is the issue of transparency. While managed funds are legally obliged and also voluntarily quite transparent in terms of their investment philosophies and the specific stocks that they hold, hedge funds are often very opaque. So you're basically betting on a dream. You're not necessarily aware of the specific, even potentially the specific philosophy or strategies, or definitely not aware of the individual stocks or assets that a hedge fund is holding. So that's a risk, and that there's a cost in terms of that opaqueness. The third difference are the investment strategies. So one thing that hedge funds definitely don't do is hedge. Okay, hedging, we know in financial markets, implies reducing risk. hedge funds tend to expose themselves to more risk than traditional assets. But when they got their name initially, hedge funds, is because what hedge funds will do that differs from a traditional managed funds is that they'll take both long and short positions in assets. So they'll short sell a lot more compared with a traditional managed fund. The average hedge fund is what we call a 130-30 fund, whereby they invest long 130% of their capital and they short sell 30% of their capital. But you even can have zero investment hedge funds where their long and short positions cancel each other out. This is called a non-directional fund, and they seek to profit from the differential price movements between the long and short arm of that trading strategy. Most traditional managed funds are either long only or have very little short exposure. Investment strategies are also quite diverse and quite exotic. Hedge funds will commonly invest in what's called a risky arbitrage strategy, things like merger arbitrage and convertible arbitrage, which is whereby they try to take advantage of price discrepancies between assets. Fourth point of difference is with respect to liquidity. So hedge funds often will have a long lock-up period. That is, when you invest in a hedge fund, there is a minimum time period before you're actually able to redeem your shares. This can be anything up to 5 or 10 years, where there's generally no lock-up requirements at all on a mutual fund. What this enables the hedge fund to do is have a longer run investment horizon and enables them to invest in lower liquidity assets and earn a liquidity premium for doing so, so earn higher returns by investing in those less liquid assets. A managed fund doesn't have that luxury without the lock-up period. And the final difference is in terms of compensation structure. So generally for a managed fund, there'll just be some fixed funds management fee. So the fund manager might get anything from 0.2 up to 1.5% of assets under management, generally depending on the degree of intervention, so how actively managed the portfolio is. In contrast, a hedge fund manager will generally get paid with an option-like structure. So it's like a call option, in that there'll be a flat management fee, but there'll also then be an option structure or a bonus paid in the event that the hedge fund outperforms some pre-specified benchmark. So what we commonly see is a management fee of 1 to 2% of assets under management with a hedge fund, and then the incentive fee equal to 20% of investment profits beyond some stipulated benchmark. What this particular structure does is, just like any option, you can increase the value of an option by increasing the volatility of an investment. So the hedge fund manager knows that they can increase the value of their option-like compensation structure by increasing volatility by investing in highly risky assets, and also by investing in assets that have a negatively skewed return distribution. So that's one of the reasons why we see that hedge funds do invest in risky assets, do invest in illiquid assets, and do invest in assets that have a negatively skewed return distribution, because it's in the interest of the fund manager for doing so. Thank you for listening to Lecture 11 on the topic of funds management.